Good evening. Today is Monday, April 3rd, and it's been a little while since I've made a video. So I want to make a short video just kind of going over what we've seen in the market the past couple of weeks. And I guess kind of give my thoughts on what I think may happen in the market coming up. So past few weeks, we saw, I guess, somewhat of a banking crisis. And here I have the banking or the financial sector pulled up, and you can actually see these giant red days. And this was all really during the crisis. So it looks like it dropped about 14%, and really, only a matter of days, maybe 8 days in there, you saw a 14% drop. Obviously, it started with Silicon Valley, but you had around on the regional banks, and a lot of people were fearing about another repeat of 2008. However, if you think about during 2008, during the financial crisis, essentially what stopped that is when the federal government came in and backed everything. I mean, trillions of dollars obviously went into the market to essentially ensure banks and AIG not going under. And once that happened, they basically put a giant put on the market, and you saw slowly over time investments come back in. You saw the market rebound. Well, essentially they did the same thing, but it was very quick. You heard Jerome Powell and Janet Yellen coming in, and they essentially ensured, more or less, when you listen to what they were talking about, all deposits in the banks, and really they have a boost of confidence saying, our banking system is secure, which I know we've heard that before, but I do think it's not a repeat of 2008. I think the issues are not near as systemic as they were in 2008. And so you really saw this rebound. If I get this out of the way, you can kind of see the financial sector rebound, stabilize and come up a little bit. However, Jerome Powell has spoken over and over again how they are devoted to fight inflation. And really at the beginning of March, he was talking about, the Fed minutes talking about how rates are going to go higher, and they're going to stay higher for a longer period than what most people think. Well, then he gets interviewed during this this quote unquote banking crisis, and he doesn't exactly walk back those words, but obviously it was new news that he had to deal with. And essentially what he said is, we're going to raise it one more time, essentially 2 more times. They raised it that week, and then they have another rate hike coming up. So it was a quarter point, and then another quarter point, and then his latest interview, he said, they're going to pause. And that is somewhat new because it sounded like that the rates were going to keep going up and up, really almost throughout the summer before they pause. So this is interesting because I think it does give some light at the end of the tunnel for the doves, as far as thinking that the Fed is going to stop raising rates or eventually cut rates. And if you really listen to any major news source, CNBC, Fox Business, you had a lot of quote unquote experts saying that the Fed should cut rates during this time, at a minimum should pause rates. And I personally didn't think that was the best decision because my guess is that it would stabilize kind of like the way it did, and you saw a small rebound, and we'll see what happens here. But the flip side of that is, because you have a pause in rates, or people are seeing the light at the end of the tunnel, the question was, well, what was going to happen to the market? And I think you are kind of seeing what is happening. I think if I'll pull up the S&P 500, you see the market really shooting up, almost getting back to the highs that it did in January. And I think this is really twofold. I do think part of this is because of the Federal Reserve giving people hope that they're about to pause rate hikes. But also, and I want to give credit, this is from Zero Hedge, and you can click this link and actually sign up and read it. But Zero Hedge put an article out there, did a good job about CTAs buying shares. So I think these two reasons are why you see pretty much all markets, the Dow, the S&P 500, and the NASDAQ shoot up. And really, I think it's came to the point where it's overextended. When you look at this price action, it looks overextended to me. And if I were to change this to a different technical analysis, you can actually see the price action reaching above that upper Bollinger Band. And you can see even down here on the RSI that it's starting to approach overbought. So I do think it's overextended. And if you read the article that Zero Hedge put out, he does a good job of talking about the buying from these CTAs really happens in the first couple of days, and then it dies off. And if I switch back here, looking at the graph, you can look at the volume, and let's zoom in. You can see the volume is pretty low relative, to some of these other days, but yet it's low to the price action where this has gone up. Let's see, it's gone up roughly 8%. You look at the volume, there's no huge green buying days, like you see here or here or here. So essentially you have these CTAs coming in and purchasing shares in a low volume environment, not a high liquidity environment. And therefore, you're seeing these gaps up, this gaps up here, and you see these gap ups. All that to say is once the CTA buying stops, which it will at some point this week, and you have this already overextended price action, in my opinion, would not be surprised if you see prices start dropping back down. Now, I'm not necessarily saying they're coming back down all the way to this low here or the lows here, but I would not be surprised if you see the price action coming back down, and at least at a minimum hitting this middle Bollinger Band here, which I guess would be about 396, 395. That would not shock me at all, because really all the markets look overextended to me. If I go to the Qs, you'll see the same thing. Actually had a small red day today, but and then if I go to the Dow Jones index, you'll see it here as well. Oh yeah, and looks like it's very overextended here. Look at the RSI really shoot up, and the Dow was negative for the year, and it's was down about 3%, almost 4% here, and so it looks like it's back to being positive for the year. So in the short term, I do. It's tell two stories, because you do have the Fed saying that they're going to stop rate hikes soon, in which you would think the market would go up from that, and it has. And then you have these CTAs that are coming in and buying in low liquidity markets that's shooting the price higher. Has made the price overextended, and therefore, when the buying stops, I will be looking for the price of these markets to come back down. The flip side of that is looking more long term. When you have the Fed pausing rates, what usually happens is inflation, and the only way to stop inflation is raising rates again. So it's a catch-22, like I've been saying, basically for 12 months now. And then you have the announcement of OPEC cutting oil production. So here's the story of OPEC cutting oil. And then, you look at WTI today and you see a huge jump up here. So you see the reaction there. Oil is going up pretty steadily, just right. If you were overlap this with the markets, you would see the oil's going up just as the market has, and then a huge gap up today. That is, large reason is just because of OPEC cutting oil production, but that wasn't announced until today or Sunday. So this price action here is going with the market. So you have the market rebound, you have rate pauses coming up. So you're seeing inflation work back in commodities. And if I go to ETF now, this also does take in oil, so you have to consider that. But here's an ETF that tracks commodities, and then you can see this coming back up. So if I had to take a guess, I would expect the market to probably dip here at some point this week, potentially next week, when CTA's buying dries up. And I would not be surprised, and we'll do another video on this when the time comes, but I would not be surprised if in 2-3 months you see inflation numbers go back up, which is going to force the Fed to raise rates. And obviously raising rates, you're going to have the market drop. It's just the ultimate catch-22 of, if you pause rates, you cut rates, market's going to go up, but so does inflation. And obviously the Federal Reserve doesn't want that. So they have to raise rates, and you're going to see the market drop. It's a weird spot to be in for sure. And as an investor, it's a weird spot to be in because you're looking for yield essentially. At least I am. And you're looking for safe places to put your money and not have these volatile returns, these huge roller coaster rides of up and down and just steady yield. And it's tough to do in this environment. So I mentioned it was the beginning of the year of where how I'm thinking about investing and where to put money. And I mentioned short-term bonds, really bills, treasury bills, and that has been a nice safe haven because there's no volatility there, and you're yielding money. You're not taking these gigantic rides as you were if you're in the market. So constantly looking for safe havens and that are yielding in this market. And it really is a stock picker's market. If you can go in and find incredible undervalued companies, they're going to do well no matter what, then you're going to do well in this market. But anyway, that's all for this video. Best of luck. And I should make another video coming up before the inflation report comes out.